Imagine waking up on an ordinary day, opening your investment app, and seeing your wealth simply vanish. Stocks plummeting, banks closing, businesses going bankrupt, and the worst part? No one warned you this was coming. Now you're trapped in the middle of chaos, unsure of what to do. If that sounds terrifying, it's because it is. But what if I told you that major financial crises don't happen out of nowhere? They follow a pattern, and the warning signs are always there. You just need to know where to look. In the next few minutes, you'll discover exactly what these signs are and how to predict a financial collapse before it destroys your life. We'll explore economic cycles, the role of fear and greed, the biggest mistakes governments make, and even how the wealthy turn crises into opportunities. And by the end, I'll show you the best strategies to protect your money and even profit in the midst of chaos. So, if you want to stay one step ahead while most people remain in the dark, stick with me until the end. Now tell me, do you think we are on the brink of a new financial crisis, or do we still have time? Comment below, and let's dive into the content. Markets are not driven solely by numbers and financial reports. They are deeply influenced by human emotions. In times of extreme optimism, investors believe asset prices will only go up, leading to irrational buying behavior. On the other hand, when fear takes over, panic selling spreads, dragging entire markets down. This cycle of greed and fear has repeated throughout history and is the primary engine behind financial bubbles. A classic example of how greed inflates bubbles is the 17th century tulip mania. In the Netherlands, tulips became a symbol of status and wealth, prompting ordinary people to sell their homes and take on debt just to buy tulip bulbs. Prices skyrocketed to absurd levels, until suddenly, buyers disappeared and the market collapsed. This was one of the first documented bubbles in history, but the same patterns persist today. In modern markets, one of the best indicators for measuring fear and greed is the CNN Fear and Greed Index. When this index reaches extreme greed territory, it historically signals that markets are overvalued and may be nearing a downturn. Conversely, when it hits extreme fear, it can indicate that assets are undervalued and present buying opportunities. The secret to long-term profit is simple but hard to follow. Buy when everyone is scared and sell when everyone is greedy. Every investor fears buying an asset at the peak of a bubble, only to watch it crash soon after. Yet history shows that most people ignore the obvious signs that they are investing in something overvalued. And the worst part? They don't realize it until it's too late. There are clear patterns that always appear before a bubble bursts, and learning to identify them can save your money. The first major sign is irrational price growth. If an asset is rising non-stop without a solid justification, such as profit growth or real innovation, that's a red flag. The 2008 real estate market was a perfect example. Home prices doubled in just a few years, even though household incomes remained stagnant. A similar phenomenon happened with cryptocurrencies in 2021, when coins with no real utility reached billion-dollar valuations. Another classic sign is when ordinary people start investing blindly, driven by FOMO, fear of missing out. If your barber, Uber driver, or relatives who have never invested before suddenly start asking how to buy a particular asset, it's a sign that the bubble may be at its peak. This happened in the late 90s with internet stocks, in 2008 with real estate, and in 2021 with NFTs. Those who bought during these moments of extreme euphoria often lost everything when the market corrected. Additionally, bubbles are always fueled by exaggerated narratives, such as, "This technology will change the world," or "This asset will never go down." History proves that every bubble is sustained by the irrational belief that this time is different. But when reality hits and fundamentals don't support the prices, the correction comes hard. Lastly, one of the most dangerous signs is excessive leverage and credit use. When investors start borrowing money to buy an asset, the risk increases exponentially. This is what turned the 2008 crisis into a global collapse. People were buying homes with loans they could never repay, believing prices would never fall. And when they did, millions went bankrupt. If you're seeing one or more of these signs in an investment, beware. it might be time to reconsider before the bubble bursts. When the economy starts showing signs of collapse, many investors rush to assets they consider safe. Gold, Bitcoin, and real estate are usually at the top of the list. But do these investments really protect your wealth during a crisis? The truth is that their safety is not as guaranteed as it seems, and those who don't understand this can end up losing a lot of money. Gold is often seen as a safe haven in times of crisis. And while it does tend to rise when markets panic, it's not foolproof. After the 2008 crisis, gold surged until 2011, but then plummeted by over 40% in the following years. Those who bought at the peak of uncertainty ended up losing money once the economy stabilized. Moreover, gold does not generate income, unlike stocks or real estate, making it an inefficient long-term investment. Bitcoin is a newer alternative as digital gold, but its behavior remains unpredictable. In 2020, many investors saw it as an inflation hedge, causing its price to soar. However, in 2022, when the Federal Reserve began raising interest rates, Bitcoin crashed by over 70%. This shows that despite its protective narrative, it remains highly speculative and sensitive to investor risk appetite. Real estate, on the other hand, is often viewed as a solid store of value. But the 2008 crisis proved that this thinking can be dangerous. Real estate can lose value rapidly when a sector bubble bursts, and unlike liquid stocks, is not easy to sell during a downturn. Additionally, during recessions, rental demand may drop, reducing investment profitability. The key lesson here is that no investment is 100% safe. The best way to navigate crises with minimal damage is diversification, spreading your money across different assets and strategies. Betting everything on a single, safe haven can be a fatal mistake. Financial markets do not move randomly. Just like the seasons, the economy follows predictable cycles of growth and recession. The problem is that most people only realize a crisis is happening when it's already too late. But what if there were a way to predict the next collapse before it happens? Fortunately, there are clear signs that have repeated throughout history and can indicate when a recession or financial crash is about to occur. One of the most reliable indicators for anticipating a crisis is the Leading Economic Index, LEI, published by the Conference Board. This index tracks 10 economic factors, such as unemployment insurance claims, new manufacturing orders, and consumer confidence. When the LEI drops for several consecutive months, it typically signals an imminent recession. Looking at the 2008 crisis, the LEI began showing significant declines as early as 2007, a clear warning for those who knew how to interpret the data. Another crucial factor is the monetary policy of the Federal Reserve. When the U.S. central bank starts aggressively raising interest rates, it tends to slow down the economy and can trigger a recession. The 2008 housing bubble, for example, was inflated by years of low interest rates and easy credit. But when the Fed started increasing rates, the cost of financing skyrocketed, home prices started falling, and the entire system collapsed. Today, the Fed is once again in a cycle of raising interest rates to combat inflation. So the big question is, are we witnessing the beginning of another collapse? Every financial crisis has one thing in common: a high level of debt. Bubbles can burst without major consequences, but when an entire economy is based on credit, a simple collapse can trigger a global catastrophe. What makes a crisis truly devastating is not just falling prices, but the fact that millions of people and businesses can no longer pay their debts, creating a domino effect throughout the economy. One of the most shocking examples of this dynamic was the 1929 Great Depression. During the 1920s, investors were buying stocks on margin, meaning with borrowed money. When the market crashed, these investors not only lost everything, but were also in debt. The result? Banks failed, businesses went bankrupt, and millions of people lost their jobs. This is how a market crash turned into a decade-long economic disaster. The same pattern repeated in 2008, but this time with the real estate market. People were buying homes with high-risk mortgages, known as subprime loans, and banks were recklessly encouraging this behavior. When home prices started falling, millions of Americans could no longer afford their mortgages, and major banks like Lehman Brothers collapsed, plunging the global financial system into chaos. Today, global debt is at record highs. Governments, businesses, and individuals are all more leveraged than ever before. This means that if a new crisis occurs, its impact could be even more devastating than past collapses. Many people believe that when a crisis hits, the government and central banks will step in to save the economy. But history shows that often, the decisions made during these moments only make things worse. Whether it's printing too much money, raising interest rates at the wrong time, or intervening disastrously, these actions can turn a mild recession into a full-blown collapse. One of the most notorious examples was the 1929 Great Depression. After the stock market crashed, the U.S. government increased taxes and cut spending to balance the budget, believing this would restore economic confidence. The result? The recession deepened even further, prolonging the crisis for a decade. Additionally, the Federal Reserve kept monetary policy tight for too long, which strangled credit and prevented the market from recovering. Another major mistake happened during the 2008 financial crisis. To stabilize the financial system, the Federal Reserve slashed interest rates to near zero and launched an aggressive money printing program known as quantitative easing, QE. In the short term, this helped prevent a total collapse, but in the long term, it created new bubbles in different markets, including the 2021 housing and crypto booms. Now, to combat the inflation caused by this policy, the Fed is rapidly raising interest rates, which is already causing new economic problems. And in today's scenario, governments worldwide are more indebted than ever and continue to spend more than they collect in taxes. Meanwhile, central banks are struggling to balance economic growth with inflation control, without knowing what the real consequences of their decisions will be. This means that if a new crisis emerges, responses could be even more extreme, and their effects even more unpredictable. The key takeaway here is, never trust that the government or central banks will save the economy without consequences. More often than not, the measures they take only delay the inevitable, and when the bubble bursts, the impact is even worse. While most people panic during a financial crisis, smart investors see these moments as unique opportunities to multiply their wealth. The truth is, the greatest fortunes in history were built during times of uncertainty, when high-quality assets were sold at bargain prices. Knowing how to act in these situations can make the difference between losing money or emerging from a crisis wealthier than ever. One of the main strategies used by successful investors is buying discounted assets. During the 2008 crisis, Warren Buffett invested billions in solid companies that were temporarily undervalued, such as Bank of America and Goldman Sachs. When the economy recovered, these investments generated massive profits. The same happened during the COVID-19 crisis in 2020, when the market crashed and then had one of the fastest recoveries in history. Another way to profit from crises is by identifying resilient and anti-fragile sectors. Companies that provide essential products, such as food, energy, and healthcare, tend to suffer less during recessions. Additionally, sectors that were unfairly punished by market panic may present great opportunities. For example, during the 2008 real estate crash, the tech sector continued growing, and years later, companies like Amazon and Google became even bigger giants. Finally, experienced investors always maintain liquidity to seize opportunities when chaos unfolds. Having cash on hand when everyone else is desperate for liquidity allows you to buy high-quality assets at deeply discounted prices. This is why Buffett's famous saying remains one of the best rules in the market: be greedy when others are fearful, and fearful when others are greedy. If you understand this principle and act strategically, you can turn crises into life-changing wealth-building opportunities. If history has taught us anything, it's that financial crises always return, but only those who are prepared manage to survive them without losing everything. But now the real question is, what will you do with this knowledge? Here on this channel, the goal is to bring you the truth about financial markets so you won't be just another victim of crises. So if this content helped you, hit the like button, Subscribe to the channel and turn on notifications so you don't miss future videos. Now I want to know, do you think we are close to another financial crisis, or do we still have time? Comment below and let's discuss. Oh, and check the pinned comment. There's something important for you there. See you in the next video.